We got a special guest today. Matt Walraven is somebody that I've got the opportunity to meet at the Collective Genius Mastermind. Your dad is a member of CG. I know your dad, Ron, very well. Thanks for hitting me up. How are you today, sir?
Good. How about you?
I'm doing great. I want to get my lighting together here. I picked a different camera angle so we can work on the whiteboard a little bit today. And we started talking. Well, first off, I met you at CG and you're like, I see your videos, because I'm always talking about money or ranting about something or the other. But today I did a post about a whole life insurance policy, and that piqued your interest because this is something that you're exploring and doing as well, correct?
Right on, right on.
So we're gonna be getting into all sorts of stuff. We were just talking about inflation. We were just talking about stocks. And if you're watching this video live, please leave any questions or comments in comments, anything in the comments below. And I have it here on my phone, so I'll be able to see it. And I'm the first one to say, like, when it comes to the life insurance stuff, I don't have all the answers, but I'll share with you what I'm looking to do with it, okay? So my main investments are in real estate. And what I'm up to with real estate, my bullish thesis where I'm at with real estate is I think the number one thing is affordable housing.
Amen to that.
Yeah. Affordable housing, number one for real estate. This is like probably 80% plus of my net worth, and then I have a self-directed. I just did a video about self-directed IRAs. And we're going to talk about that. And I'm starting a whole life insurance policy. And this is like the game that I'm playing right now. So this is number one. Everybody who follows me knows I like the affordable housing stuff. I think, we're headed into a time of inflation. I posted today that, 1 trillion seconds is equivalent to 32,000 years. And the central bank, the Federal Reserve, has printed $3 trillion. So, this doesn't come without a price. There has to be cause and effect here, right? So we were just talking about stocks because I was telling you, oh yeah, I do some stuff in the stock market as well. But what I do with the stocks, we'll start here, is, basically just day trade and swing trades where I'll buy shares. I'm very short-minded and short-sighted with the stock market stuff because I think it's completely overvalued. I think it's totally pumped up. And a lot of that has to do, without a doubt, because the Fed printed all this money. The Fed is buying all these corporate bonds. Interest rates are so stinking low that people and corporations and whatnot are able to borrow all this money and they can buy their own stock, and it drives the prices up, and people are just throwing money into the stock market right now. And that's why it's so pumped up and inflated. But again, my thesis consists of, I think it's all overpriced and overvalued, and people are not buying stocks based on fundamentals of the company. There's something called these zombie companies, if you will, and that's just where the company's like barely making any money and they're just borrowing tons of debt. It's like Airbnb and DoorDash. I was posting about that like last week or whatever. These companies don't even make profits, but the venture capital guys out in Silicon Valley, they invest in these companies and they get these companies all big and fancy and shiny, and then they take it IPO. So they offer shares of the company to the public, sell all the shares of a company that's not even making money so they could cash out. That's just what they do. It's like these zombie companies that are riddled with debt and not making profits. And 19% of the companies traded in the stock market, Tesla being one of them. I mean, think they're making profit. They're better at selling stock than they are at selling cars, right? And it's
Right.
the most traded company in the S&P 500 and on the stock market. Think about that. But so I'm very short on the stock market, but I enjoy just little daily profits here and there. I'm just bobbing and weaving on that kind of stuff because it's fun, because I'm a trader naturally. I built a card collection when I was a kid, and I just enjoy the research that goes behind it and the charts and stuff like that. Real estate is my number one mainstay. And when buying real estate, what we do is we borrow from private lenders and we buy off-market properties. And that's what you do as well, right, Matt?
Exactly. Yep.
So a lot of what you're doing and us as well is we'll buy them and we'll, fix them up, clean them up or whatever, and sell them. That's our flipping business. But we also hang on to them. So what we do, and I think the best move right now, since the interest rates are so dirt cheap, is buy these off-market properties in the affordable housing sector, right? And then get them fixed up, get them rented out, and then refinance them with 30-year money. Are you doing any of that, Matt?
Yeah, absolutely. And right now we're even going the conventional route. So we're getting 3 to 4% 30-year amortized loans in an LLC, right? So, I mean, those interest rates being driven down is insane at the moment.
The reason I think that's the best trade is because, the person who wins in inflationary times is not the creditor or the bank, it's the borrower, because the money they loan you today to secure this asset that produces you cash flow today, the money that you use to pay it back down the road is worth less than the money they gave you today. So you're coming out ahead, and then you also get to write off a piece of this interest. So your net cost of money is not even 3.5% or whatever you're paying right now. Your net cost is actually lower. And then you can use what is called, cost segregation, accelerated depreciation, to write off future losses against today's wholesaling profits. So you got your wholesale side of the business, and then you got your buy and hold. And if you could secure your buy and hold portfolio with low interest long-term debt, and then depreciate this against your wholesaling business, you barely pay any taxes. That's a real good way to be successful.
It's not a huge thing, but it's a little detail that a lot of people overlook, is you're gaining equity every single month on a 30-year or an amortized loan, right? So it's small, but as far as net worth building, that's another strategy in order to do that.
That's it. I mean, you're chipping away at the debt every single month. And if it's not even your money, if a tenant is paying, they're paying off the loan. I mean, that's why that's real estate 101. It just makes all the sense in the world. So we're doing that. This is the majority of my business is wholesaling. But actually, what we realized is we're making 40% more on wholesale deals. And a wholesale, for those of you watching, if you're not familiar with the difference of wholesale versus wholesale. Wholesale is where you secure a property in contract and then essentially sell that contract to another end user type of buyer or investor. So if I tie up a property for $50,000, but it's a good deal to somebody else for $60,000, I will sell that contract to them for a $10,000 fee, and then they'll fulfill the contract for the $50,000 with the seller. I made a $10,000 spread, if you will. That's wholesaling. I never took title to the property. I just carved up the contract. Wholetailing, for those of you who are not familiar, basically it's actually taking title. So what we do is we'll buy this property that's a fixer-upper, and we won't do a full-blown remodel on it. Instead, what we're going to do is just kind of clean it up and knock the ugly off it, is what we like to say. And then we'll list it on the open market, and a buyer will come in and we'll create a spread. So it's like flipping, but not doing a full-blown rehab, because you don't need to do that. Do you guys do both wholesale and wholesale?
Yes. So mainly before COVID, we took everything down. We were wholesaling everything. But of course, so the biggest things to consider when you're doing that is if you're wholesaling, specifically using private money. Our case was we were paying points for the private money plus a certain percentage on the loan. And then we trash it out mostly. Most of the time, all we did was trash out the junk. We didn't paint it or anything. But the kicker there was we were doing that pre-COVID, and COVID hit, and in different markets, it's different, obviously. But in our market, the investor base just dried up. They shriveled up. They weren't going to do anything until like
You know
just fuel
why?
up.
You know why they shriveled up?
There's several answers, but what are you getting at?
Well, I mean, as you probably know, it's just all the money, all the institutional money went away. COVID came. They're back now, like the Lima ones and the Corvest and the
Oh,
institutional
absolutely.
money. And that just shows you why private lending is so powerful. And Dr. David Phelps was probably smiling if he hears this one, but it's the absolute truth. The bank will just institutional money, these lenders who investors were using to fund their fix and flips. They'll just close the doors on you anytime they see fit. But having relationships with private lenders is going to be the key. And that's what we did as well. I mean, we were still buying all through COVID and whatnot, never had to stop, but a lot of buyers did stop. So what you were getting at is you used to take it all down and then sell it to investors, but a lot of the investors dried up when COVID came. That's where you were at.
And the way it bit us is it was roughly about 20 properties going into COVID. And now we're stuck with properties that we own, that we're accruing interest on, that now people aren't willing to buy. Now, in hindsight, all those guys are looking back 5-6 months ago and going, dang it, I should have bought everything and flipped it, because now you have such the insanely low interest rates. Our retail market here in Metro Detroit is insanely hot. So for prettied up houses, it's very hot. But so when COVID hit, what we did is we switched to strictly assigning with a 60-day option. So if we're absolutely positive that we'll be able to take it down and make what we think we're going to make, we'll not promote that 60-day option, because why even have to sell it if you don't need to? But also, if, for instance, if a seller is stuck on their price, we'll go with your number. We're going to blast it out to our buyers, and we're going to have 60 days to test it out. Now, if your number doesn't work, we're going to come back to you and go, hey, this is what you wanted. We couldn't make it happen. Then we go back to cash route. So ever since COVID, we've been doing strictly assignment unless we're absolutely positive that's a good deal.
Well, yeah, I mean, because that's the kicker right there with the wholesale, where you don't take title. There's less risk because you're not putting up the private money, doing a rehab or anything like that. Now, the profits, we're seeing 122% more profit on a wholesale deal than a straight wholesale deal, because the buyers on the MLS, where we actually have title and then we clean it up and list it, they're willing to pay way, way more. These retail type of buyers who just want to get their hands on a fair, good deal, they're going to pay way more than the investor cash buyer that we used to assign to. So you might want to look into the wholesale is massively, drastically more, because the MLS is where all the buyers that pay more are. And you have to have title in order to sell it on the MLS. So
I should add one more thing. We're doing another, which of course, Dave, you're very familiar with this, but subject to deals where we're taking
get as many as you can.
And then one thing we found, which is very interesting, is we've been selling them as land contracts to our buyer, collecting a downfront fee. But one of the things we've been seeing is a lot of times our buyer, which is typically just a retail buyer, is willing to take a higher interest rate for a lower down payment. So for instance, we had one, they were willing to give us 25 grand down on a roughly $200,000 property. They wanted to give us 6 or 7%. And we went back to them and said, hey, put 20 down, but for 8%. And it was a $22,000 difference over 5 years. So even like little tweaks like that have been very successful for us.
So there's two schools of thought, and what Matt is referring to is buying it subject to. That's basically where the homeowner is, selling you the house, but leaving the loan in their name, and they're going to send, deed you the property. And we're not going to go down the rabbit hole of training you on that, but it's a very, very effective way to acquire properties, and we're big fans of it ourselves. Now, I'll tell you, there's two schools of thought when it comes to your disposition strategy on the sub twos that you're talking about. And what you're essentially doing is selling it on a wrap, right? Like on a land contract. Is that correct?
Yeah.
So the alternative would be, because what he's doing is basically selling it to an end user and then selling it to them and carrying the note for this end user. And it's like a wraparound mortgage because that existing mortgage with the seller is left in place. Now, other exit strategies that you can do with a subject to deal, if you intend to hold it, would be or just a straight up rental, just rent it out, or do a rent to own. And I will share this with you. Now, two schools of thought, neither one is right or wrong, but I know Eddie Speed, Mr. Owner Financing, I've been to his class and whatnot. He's all about doing it that way. You know, buy it on owner finance. I'm sorry, on subject to, buy it subject to, and then sell it, you know, on a rack. Like Eddie will teach you that inside and out, and he'll teach you to do it the right way, and that's great. I'm not a big fan of that because I don't want to basically wrap a government-backed loan that I didn't even originate. These conventional mortgages and stuff, I would rather just do a straight up rental because I don't want the public records to change, right? Like when we do a sub-2 deal, we'll put it into a trust. And I would be somewhat fearful about, you know, changing ownership with that underlying note in place. That's just me personally. Eddie will tell you that's exactly the way you should be doing it. I'm not a big fan of giving up that ownership with that underlying loan. It's just something that that I feel. That's just me though.
So just to clarify what you're saying, because we've done the same thing as well, I believe, is you're still keeping the debt in place. You're just transferring the ownership to the trust that you're putting the property in.
100%. So we'll take title with a trust, and you know you're the beneficiary of the trust, and you got to have a trustee that's on public record, and you know the seller deeds the property into the trust in which you're the beneficiary of. So you own all the benefits of the trust. The loan is left in place, and you just pay the payment like you normally would. So I don't, and this way you have title. It's just a trust though. It's not in your name. Therefore, you know, if and when public records change, it just shows it's like a 123 Main Street Trust, you know, instead of like some totally third party. I just think, I think it's a little bit safer to do it that way. And I'm not a big fan of giving the ownership with, you know, this underlying debt. I'd rather just do a rent or a rent to own. This way you maintain the ownership, and then if and when you change ownership and sell the property, they're coming in with new financing and cashing out that old sub-2 loan. That's just the way I would do it. But to each his own. Eddie will tell you the way you're doing it is the way you should do it. So it's just different strokes for different folks, right?
Yep.
I would encourage all of us to get as many of those sub-2s, own as much real estate in the affordable housing sector as you possibly can. So I think we're headed into high inflation, and you know what wins in inflation is owning real assets. And if you can be in the affordable housing sector, that's where you want to be. You know, you're already seeing lack of demand in the super high-end areas like San Francisco, Manhattan, stuff like that. We're in the Midwest. We're Midwestern guys. So it's, I want to gobble up as much of this real estate as we can, because people will move from the high dollar overinflated areas like the coasts, and they want to be in the Midwest. They want to be in the Southeast, you know, and we're already seeing it. You know, people are fleeing California at record numbers because it's way overtaxed. It's way too expensive to live there. And now if you have the opportunity to work from home and you live in a high dollar market, why not move to a cheaper place? You don't even have to change jobs. It's perfect. Right. You know, if you got a high paying job and you can work from home, why not move to the suburbs or move to a different state that's more tax friendly? And I think there's a big market for suburban affordable housing in tax friendly places like Ohio.
Even to mention, all these forbearance loans are going to be coming due, right? So you're going to have people with hurt credit who wouldn't necessarily be able to go get a mortgage, but who are qualified buyers from a cash perspective. So that's another reason to be dumping everything into single family housing for sure.
I like single fam. I like rents, you know, renting properties out just for all the benefits we've already mentioned. But with idle cash, you know, when you're making cash, that's the play here. So for the different entities that we're talking about here today. So what are we talking about? Self-directed IRA. Here's the kicker with the self-directed IRA. You could grow money in there. And there's two different kinds of IRAs. I just did a video with Derek Long on this, and I tagged him in this video. So there's a traditional IRA and a Roth IRA. Excuse me. A traditional IRA is you put money in there and you could grow that money with an investment, and all of your gains, they go back into this IRA. All of your profits go back into the IRA, and then you don't have to pay tax on it until some date in the future. It's deferred until some time in the future. The problem with that, Matt, is the taxes, I believe, are going up, not going down. For sure they're going up. So you're deferring these taxes into the future, but what if the tax rate's higher than they are now?
Right.
And I think likely they will be. So I'm not a big fan of deferring the taxes to pay them later in the future. I want to go 100% tax free. And that's where you get the Roth IRA. So I got a self-directed Roth IRA. And this is where you put money into it. You're allowed to contribute $6K a year of your after-tax dollars. And then with a self-directed IRA, you can flip houses, you can lend money. This is what we do. And then all the gains and all the profits go back into this IRA, self-directed IRA. And you got to wait though until you're 59 and a half. That's the kicker. Right. So you can make a bunch of money and do a bunch of stuff, but you can't touch that money until you're 59 and a half. That's just the way it is. So you grow this money, but it's not deferred until you're 59 and a half. After 59 and a half, you can start taking that money out, and it's 100% tax free. So that's what we do with our self-directed IRA. Self-directed meaning we can do whatever we want with it, real estate transactions. And if you're wholesaling, it's a good opportunity for you guys to wholesale a property, just a couple properties a year. You can't make it like a full-blown business running out of your IRA, because then you're going to have to pay something called UBIT, which is it's a business tax. I think it's universal or something, business income tax, right? UBIT. And so yeah, that's what we're doing. I mean, we'll wholesale a little bit out of that self-directed IRA, just a very little bit, so we don't have to pay that UBIT. But then we'll lend money. We do private loans. This way we get that money working and we get paid back. It all goes back into the IRA, and then it's all tax free till we're 59 and a half.
Right.
So.
Right. And that's specific. Obviously, real estate is one of those investment classes that you're allowed to use with those self-directed IRAs. But another thing to consider is you're limited on what you can do with those funds, right? Real estate being one of them.
You're unlimited is what you said?
No, you are limited.
Yeah, but it's pretty flexible. I mean, you're not allowed to buy like art or something like anything that we deal with, you can do pretty much with an IRA. So notes, lending, and real estate is like my main business. So I'm not restricted whatsoever with that. I have another IRA with TD Ameritrade, and that's what I use for the stocks, right? I got a little IRA with them, but the self-directed IRA specifically is for real estate. And I use a company called Quest IRA, and I tagged Derek Long in this video, so check out Derek if you are looking to start a self-directed IRA. Tell him Dave P sent you. I get a little golden star, I think. But now I am getting into the whole life insurance play, and that's what got us first on the phone here. And the way I understand it with the whole life insurance is it's just an alternative to a savings account, because a savings account at the bank is going to pay you like nothing, right? So the way I understand it is you deposit the money into the whole life insurance, and let's say it's growing at 4%, right? So let's say you put in $100,000 and it's growing at 4%, and that's much better than the bank. If you need this money, then you can pretty much access the money depending on how the plan is created. And then you got guys like, Chris Miles and John Dwyer. They're experts with the stuff. So work with an expert to help you devise your plan. So if you put in 100 grand, it's working at 4%. And then essentially, if you need that money for a big purchase, let's say you need 50K, well, you could go and get that money and borrow the money at like 2%. So your money never stops growing and compounding at whatever interest rate that you're getting on the whole life insurance plan. Your whole 100,000 is just chilling there, earning 4%. Now, if you need money, you can pull it out, but the money, you're not pulling it out, you're borrowing, let's say 50,000 against your policy, but the money that you're borrowing, that 50,000, they're only charging you like 2%. So your yield is still positive if you need that money, right? So your 100K never stops growing at 4% or whatever. And then if you need the money, you can pull it. However, you're going to pay like a small interest rate because it's a loan. You're not actually withdrawing the money. The money's never withdrawn. It just keeps growing and growing and growing. And let's say you pull out 50K, you're paying 2% on that 50K. You use that money to go flip a house. The profits now go into your bank account. That's fine. And then you just pay back the 50K loan that you borrowed against your whole life insurance policy. Does that make sense?
Yeah, now something that we might want to clarify too is I am not positive on whether or not you actually have to pay an interest rate if you take money out of that account. I was under the impression that it's so let's say you have a $1 million death benefit because it's a life insurance policy, right? They continue to pay your 4% on the principal that you've put in. But then if you withdraw the money, the only kicker is the fact that your death benefit is reduced by the amount that you withdraw. So if you said what you just said, where you have $1 million death benefit and you withdraw 50, now if you passed, your beneficiary would get 950 instead of the million.
Well, there you go. And that's why we're relying on experts like Chris and John, because we certainly don't know. But what I do know is our money never stops growing at that predetermined, that yield of 4% or whatever. And then we can pull the money, it'll be in the form of a loan, not a withdrawal, right? And yes, it is secured against your, death benefit. You're exactly right. I don't know what the interest rate is, but my play here, Matt, is to build this thing up. It's an alternative to a savings account. And then if and when I want to pull that money and flip a house or do something like that, I can do that. I just like the idea that it's growing and compounding at a much better rate than the bank. It's relatively safe money, and then I can still access it and flip houses or do whatever I want. You know what I mean?
Before you're 59 and a half, right?
No, exactly. Before the 59 and a half, that's the thing. So the self-directed IRA is great because that's where we can grow our tax-free stuff, but we can't touch it till we're 59 and a half. With the whole life insurance, sure, it's a smaller yield that I'm getting, but I can access it tomorrow and I can do whatever I want with that money, and I can use that money for other investments and stuff. So that's why I'm doing that.